Stuck in a trading range. That's where the markets are. What happens next? That's today on 3 Minutes on Markets and Money. For the last 7 days, markets have really just been stuck in a big giant trading range, not really going much of anywhere. Now, the good news yesterday was that markets opened lower yesterday morning, came right off this support that we had opened up with last Monday. Bounced off that. Markets did close up yesterday almost 1%, back towards the top of this trading range that, again, we've been in now for the last 7 days. A lot of vacillation in the markets, with markets really going nowhere. And this has been one of the challenges for the markets in general, is to really make some traction. Now, we had talked about getting that early buy signal back several weeks ago. That has played out rather well, and markets did rally here. And we've been recommending that on this rally to raise a little bit of cash and hedge portfolios a bit. We now have 3 problems for the markets currently. The first problem is that markets have rallied back to the top of this trading range, and the top of that trading range is also where the bottoms of the very similar trading range was back in late April, early May. That trading range broke down and the markets declined, providing this buy signal that we did get back here on around May the 12th. So again, markets kind of bottomed there and then rallied here mildly. We didn't get a great rally out of this, but we did get a rally as expected. And now the second problem is that buy signal is now getting very overbought and beginning to narrow. So again, a lot of that fuel that we had saved up in the tank for this rally has been utilized on this rally. And the longer that we consolidate in the sideways trading pattern, the more of that fuel we're going to continue to eat up here. So that's going to limit the upside. The third problem is really twofold. That is because the 50-day moving average is now coming down to the top of this trading range, which is limiting that upside advance, another level of resistance that we're having to deal with. And that also coincides with the downtrend line that we set back not only in March, but all the way back at the highs of this year. That downtrend line also sitting right on top of this 50-day moving average. So as we continue to kind of grind sideways here, more and more downward pressure is being put on the markets. This is why we've been suggesting raising a little bit of cash. Now, yesterday we did start selling and raising some cash in our portfolios. Not a lot, but we also started building a short market hedge in the portfolio as well to help hedge the portfolio if markets do break to the downside, which would set up a retest of those early May lows. As the markets rally here, we'll continue to build that short market hedge. We'll continue to raise a little bit more cash. That seems to be right now at least the prudent thing to do in this environment. More and more indicators talking about slowing economic activity. The Fed is hiking rates next week. They are tightening their balance sheet, $60 billion this month. So a lot of reasons to remain concerned about market stability right now. However, if for some reason the markets are able to break out of this trading range and move to the upside, fairly simple process of removing those hedges, putting cash back to work. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll look at the markets again tomorrow.